Welcome to The Explainer. So today we're tackling the absolute holy grail of modern finance, measuring market risk. It's this invisible, totally unpredictable beast, right? Over the decades, financial theorists have essentially been trying to build a better mousetrap. They want the perfect mathematical model to pin down exactly how much you, the investor, should be compensated for taking on risk. Let's walk through how this whole fascinating concept evolved. Here's our clear, step-by-step roadmap for today. We're going to start by defining and diversifying risk, then hit the capital asset pricing model, move on to the arbitrage pricing model, check out multi-factor and proxy models, and finally, compare them all to see how they stack up.
All right, part one, defining and diversifying risk.
Okay, let's dive into this. Pretty much all risk and return models agree on this foundational three-step process. First up, you actually have to define risk in statistical terms, specifically as variance. Step two, you take that risk and slice it right down the middle, the risk you can diversify away and the risk you simply can't. And finally, step three is where the models actually try to measure that non-diversifiable market risk. Keep this three-step mental model in mind because it's the foundation for this entire explainer. Look at the riskless investment on the far left here. The actual returns always equal the expected return, right? It's just a single vertical line. Zero variance, no surprises. But as you move over to that high-risk investment on the right, you get this wide, flattened curve. That spread visually represents a much higher variance. Your actual returns could be way higher or a total disaster and way lower than expected. In the finance world, that variance literally is the risk. So, moving to step two, decomposition. We take all that variance and split it into two buckets. Firm-specific risk, which just affects one or maybe a few investments, and market risk, which basically hits everything. Now, here is the secret sauce to modern valuation. We assume the marginal investor, the big player whose trading actually dictates market prices, is already fully diversified. Because they hold this massive portfolio of assets, all those little firm-specific risks, they just wash out and average down to zero. So they only care about and only demand a premium for market risk.
Moving to section two, the baseline, the capital asset pricing model, or CAPM.
For decades now, CAPM has been the absolute gold standard. It is incredibly elegant, but to get that elegance, it has to assume a completely frictionless, frankly, utopian world. We're talking no transaction costs, zero private information, and infinite divisibility of assets. In this financial fantasy land, CAPM assumes that every sensible investor out there is going to hold a piece of literally every traded asset. Everyone is holding the exact same identical market portfolio. And that leads us to the absolutely crucial point here. Because everyone is holding the exact same massive market portfolio, CAPM is able to boil all market risks down to a single number. Just one. And you know it is beta. Beta simply measures the specific amount of risk that any one individual investment adds to that giant universal market portfolio. And this brilliantly illustrates how that single beta translates straight into valuation. Your expected return is just the risk-free rate plus your beta multiplied by the market risk premium. It is so clean. And honestly, this formula is the shared mathematical DNA for almost all the competing models we're going to look at today. They basically all rely on some version of a risk-free rate plus a beta times a premium. Which brings us to section three, the challenger, the arbitrage pricing model. But what if the market portfolio isn't the only thing driving risks? Eventually, practitioners started pushing back hard on CAPM's utopian assumptions. So the APM takes a totally different route. Instead of assuming this perfect, magical market portfolio, it assumes that investors are essentially sharks. They will fiercely hunt down and eliminate any arbitrage opportunities, any chance for a riskless profit. To prevent that arbitrage, assets with the exact same risk exposure have to offer the same return. But here's the kicker. Unlike CAPM, APM argues that market risk isn't just one monolithic thing. It's driven by multiple, unspecified macroeconomic factors, and each one of those needs its own beta. If we look at the APM formula, it breaks your actual return down into the expected return plus M plus epsilon. That M is really the star of the show here. It stands for the market-wide component of unanticipated risk. Think surprise spikes in inflation, or sudden, unexpected shifts in interest rates. APM says there are multiple M factors pushing the broader market around, not just one single market portfolio.
All right, section four, multi-factor and proxy models.
Now, APM was definitely a breakthrough, but it had one pretty glaring weakness. It never actually defined what those statistical factors were. They were just kind of there.
Multi-factor models are the natural evolution of that. They provide the concrete economic basis that CAPM was missing. So instead of mysterious, unnamed forces, a multi-factor model steps up and explicitly states that market risk is driven by changes in things like gross national product, inflation, and interest rates. It actually names the exact macroeconomic forces, which gives analysts real-world, trackable variables to work with.
And then we have the ultimate rebels of the group, the proxy models. Back in the early 90s, researchers Fama and French noticed something huge. CAPM's beta actually did a pretty terrible job of explaining real-world stock returns between 1962 and 1990. So what did they do? They threw economic theory completely out the window. They relied purely on historical data and found two observable market characteristics that acted as perfect proxies for risk: company size and price-to-book ratios. The data showed that smaller companies and companies with low price-to-book ratios just consistently earned higher returns. They basically argued, hey, these physical characteristics are way better proxies for market risk than some theoretical beta.
Finally, Section 5, comparing the risk models and synthesizing it all. Now, what's really interesting about this slide is how it perfectly maps out the entire evolutionary timeline we just talked about. If you trace the lineage straight across, you start on the far left with CAPM's super elegant single market portfolio. Then you move right into APM's multiple but unspecified factors. Keep going to multi-factor models, which explicitly name those macroeconomic variables. And finally, way over on the right, you hit proxy models, which just bypass economic theory entirely. Think of this summary matrix as your ultimate cheat sheet. In CAPM, your measure of market risk is just one beta against the market. In APM, it's multiple unspecified betas. In multi-factor, you're looking at macro betas. And in proxy models, it's all about physical company characteristics like market cap. But at the end of the day, every single one of these is just a different mousetrap, and they were all built to catch the exact same mouse, non-diversifiable market risk. And yet, despite all of these highly complex, extremely data-heavy challengers that came along later, our source material highlights a really fascinating reality from Aswath Damodaran. He points out that the survival of CAPM as the absolute default model for risk in the real world is really a testament to its intuitive appeal. The truth is, the more complex models just failed to deliver a big enough improvement in predicting expected returns to justify abandoning the clean, elegant logic of CAPM. Honestly, sometimes the simplest mousetrap is just the one people keep reaching for. We've covered a ton of ground today, from the frictionless utopia of CAPM to the relentless arbitrage hunting of APM, the macroeconomics of multi-factor, and the pure data rebellion of proxy models. They all offer a completely unique lens on how to measure the unmeasurable. So I want to leave you with a provocative question. When you look out at the financial markets today, which of these models actually aligns with how you see the world? Which asset pricing model best fits the risks in your own personal investment philosophy? Give it some thought. Thanks for joining me on this explainer, and as always, keep questioning the models.